morning and welcome. You've tuned in to the Bulls, Bears, and the Bell morning edition of the Deep Dive.
Great to be here.
If you need that shortcut, that quick way to get fully informed about what's shaping up to be a really complex start to the trading week, this is November 4th, 2025, well, you're definitely in the right place.
Absolutely. We're diving deep.
We've got the market intelligence right here, and we're going to break down what really matters before that opening bell rings.
And there's a definite tension, isn't there? It's something you really need to pay attention to today.
What are you seeing?
Well, the big picture, the broad index environment, it feels like, let's call it cautionary profit taking. There's real uncertainty out there, macro uncertainty, driving investors to sort of, pull back risk.
De-risking, okay.
And this is the crucial part, underneath that surface caution, we're seeing some incredibly strong specific opportunities. Real micro-level alpha.
Alpha meaning potential outperformance, right?
Exactly. So it's a market that, frankly, might punish you if you're just passively holding an index. But it looks set to really reward very selective, fundamentally driven choices. Understanding that split, that segmentation, that's key this week.
Okay, so that's our mission for this deep dive then. We need to connect those almost conflicting signals for you, the listener. We're going to tackle three things today.
Three key pillars.
First, the big picture. Index sentiment from the futures, those global risk signals setting the early tone. Then second, we'll pivot. We'll look at those specific stocks, the pre-market winners generating that micro-alpha. What makes them tick? What does their success tell us?
And that second part is fascinating, revealing what the market actually values right now.
And finally, the third piece, the calendar. It's heavy this week. Macroeconomic data, corporate earnings. These are the events that are going to really dictate the direction and probably the volatility for the next few days.
Let's get into it.
All right, let's jump straight into that immediate market bias. What are the futures telling us right now ahead of the open? Okay, let's unpack the futures. The data we have shows, well, moderate negative pressure overall, but it's where that pressure is concentrated that seems really telling, right?
Absolutely. You've got this synchronized negative pressure across the main U.S. index derivatives. But if you dig into the actual contract data, the divergence in risk exposure, well, it's very instructive.
So not all indices are feeling the same heat.
Exactly. Let's look at the tickers. Take the micro E-mini Dow futures, that's MYMZ5, the Z5 meaning December 2025 expiry. It's down, but only moderately, maybe 0.37%.
Okay, 0.37%. Relatively stable then.
Relatively stable, yes. It suggests investors are sort of holding the line in those more traditional sectors, industrials, value stocks, the kind that make up the Dow. Less immediate panic there.
Okay, now contrast that with the NASDAQ, the tech side.
Right. Now look at the micro E-mini NASDAQ 100, the MNQZ5. That's showing a much sharper drop. We're seeing it down around 0.75%.
Wow, so more than double the Dow's decline.
Pretty much. And that gap, that difference, it's not random. It tells you the de-risking is very focused, very targeted. The hesitancy is aimed squarely at those high beta, growth-oriented tech stocks.
And just to remind everyone, high beta means these stocks tend to move more dramatically than the overall market. They amplify the swings.
That's the one. They fly higher in rallies, but they fall harder in downturns. And why hit them now? Well, they're very sensitive to interest rates.
Oh, rates, of course.
Investors are doing this targeted selling precisely because we've got two massive events looming today. First, that crucial JOLTS labor market report. Second, tonight's big tech earnings, AMD and Supermicro especially.
Okay, connect the dots if JOLTS is hot.
If JOLTS comes in strong, suggesting the labor market is still tight, the thinking is rates stay higher for longer, and high-growth tech stocks, they rely heavily on cheaper borrowing, cheaper capital. So investors are selling before those potential negative catalysts hit. Moving to cash, maybe rotating into less sensitive areas.
And that pattern, that targeted selling in tech futures, it shows up in the volume data too, doesn't it? Particularly in the smaller contracts.
It really does. The volume in that micro E-mini NASDAQ contract, the MNQZ5, huge. 161,007 contracts traded already. That's significant volume in the micro contract.
Which is 1/10 the size of the standard E-mini. Why is that important?
Because it points to really broad participation. It's not just the huge institutions. Retail traders, smaller funds, they're all actively involved using these smaller contracts for tactical moves. They're hedging, they're speculating, they're preparing for what they expect to be a very volatile day around these data releases. Nobody's just sitting back.
So a lot of active positioning ahead of the noise. Okay, we've established the domestic caution is focused on growth. But is this just a U.S. thing, or are global markets singing the same tune? Hashtag tag tagged 1.2 intermarket flow and global risk-off signal.
Oh, it's definitely being reinforced globally. This isn't happening in a vacuum.
What are we seeing overseas?
We'll look at Asia overnight, mostly lower. Japan's Nikkei, down about 0.36%. South Korea's Kospi took a bigger hit, down 1.6%. Shanghai Composite was off just slightly, 0.19%. And Europe, following the same pattern. Euro Stoxx 50 futures are pointing lower, down about 0.8%.
That's pretty much a global risk-off signal then, almost synchronous.
It really looks that way, near synchronous caution.
What's the common thread? Is it all just fear about the U.S. Fed and joltis today, or is there something else knitting this together globally?
It's definitely a compound effect, but central bank actions elsewhere are playing a key role. Take the Reserve Bank of Australia, the RBA. They just met and decided to keep their main interest rate steady at 3.6%.
Okay, a pause from the RBA. How does that ripple outwards?
It's not just the pause, it's the reasoning.
Mm.
The RBA specifically highlighted lingering worries about sticky inflation. That statement, coming from a major central bank, confirms this isn't just a U.S. problem. Inflation, particularly in services, is proving really stubborn worldwide.
Right, so even if the RBA paused, their commentary still points to this global inflation persistence. Why should a trader watching, say, the S&P 500 care specifically about the RBA's inflation concerns?
Because it validates the idea that high interest rates might be here to stay globally for longer. U.S. companies rely on global supply chains, global demand. If inflation stays sticky everywhere, as the RBA implies, it makes the U.S. Federal Reserve's job much harder.
It reinforces the need for the Fed to stay vigilant, maybe stay hawkish.
Precisely. It compounds that domestic bias we see in the Nasdaq futures. So when you see European futures down, Asian markets weak, and U.S. tech futures selling off ahead of a major U.S. labor report, it tells you the market isn't just bracing for U.S. data. It's positioning for broader, sustained global rate fears. It puts this morning's tentative open into that larger context.
Okay, this is where it gets really interesting, that counter-narrative you mentioned. This is where the deep dive really pays off, I think. Because despite all that index caution, that de-risking, certain individual stocks are absolutely flying.
Yes. It shows that investor appetite for alpha, for specific gains, is still huge if a company meets the market's current criteria.
And a prime example is Pediatrics Medical Group, ticker MD. This one's a really important case study, isn't it? Tells us a lot about what the market values right now.
It really does. MD is soaring pre-market up, 24.22%. And the reason why is maybe the single most critical insight for anyone listening today. It's just a perfect example of this market segmentation rewarding a specific kind of discipline.
And the data is almost counterintuitive because the big driver isn't sales growth, it's profitability, pure and simple. Can you highlight that contrast for us? Why is that so powerful today?
It's powerful because it essentially redefines valuation in this kind of environment. Look at Pediatrics' numbers. Their operating margin, it expanded dramatically. Went from 6.6% a year ago to 13.8% now.
Wow, more than doubled their margin.
Huge improvement. Massive step up in efficiency and cost control. But here's the kicker, as you said. Their actual revenue contracted. Year-on-year, revenue was down 3.6%.
So they sold less but made way more profit on what they did sell.
Exactly. And then management basically validated this whole strategy by significantly raising their forecast for the full year 2025 adjusted EBITDA. They bumped the range up to $270 million to $290 million. That's well above what analysts were expecting.
And the market's response? A massive plus 24% jump, rewarding them for shrinking the top line but nailing the bottom line. So what's the big signal here? What does this MD story mean for how we should think about other stocks?
The implication is profound, and it ties right back to that high cost of capital world the Fed has created. Remember when interest rates were basically zero?
Yeah, growth at all costs.
Exactly. The market rewarded companies purely for top-line growth, even if they were burning cash like crazy to get it. Market share was everything now. Money's expensive. Borrowing costs are high. Discount rates on future earnings are high. So the market's priorities have flipped.
It's demanding profitability.
Demanding it. Profitability, margin expansion, really disciplined operational control. That's valued way more now than just chasing sales numbers.
Okay, but let me push back slightly here. Is there a risk? This is short-sighted. If MD is boosting margins so aggressively, could it be cutting corners? Maybe hurting long-term growth prospects or even patient care to hit those numbers? Aren't investors just buying a temporary boost?
That's a very fair and critical question. Absolutely. There's a long-term risk if margin gains come at the expense of core service quality or necessary investment. The market right now seems to believe either that the margin expansion is sustainable or perhaps more likely that the previous cost structure was just incredibly bloated and inefficient.
So they're rewarding the cleanup effort, basically.
In the short term, yes. Superior earnings quality, meaning profits backed by actual cash flow and healthy margins. That's setting a new benchmark. What this tells us is any company still chasing that old growth at all costs playbook without showing corresponding margin improvement. They're likely to get punished by this market. You need to take this MD metric, operational efficiency, margin discipline, and apply it as a filter to other sectors. Think SaaS, e-commerce, areas that traditionally spent heavily on marketing for growth. Are they adapting?
Great point. Efficiency is the new growth, it seems. Okay, next up, another big pre-market mover, cipher mining, CIFR, up over 22%. This one feels like it's riding two powerful waves at once, crypto's recovery and this huge AI infrastructure story.
It's a perfect example of thematic convergence. You nailed it. CIFR benefits, yes, from crypto prices bouncing back, but the real excitement, the reason for that big jump, it's about a smart strategic pivot they're making. It validates their potential beyond just mining.
Tell us about that pivot. How does a crypto miner suddenly become an AI infrastructure play? That seems like quite a leap.
Well, think about what crypto miners have. They've built these huge, specialized data centers. Massive power requirements, sophisticated cooling systems. It's complex infrastructure.
Right. Built for one specific purpose, mining coins.
Exactly. But what companies like CIFR are realizing is that this infrastructure, this power capacity they've secured, it's incredibly valuable for other things too. Specifically, high-performance computing HPC and hosting the hardware needed for AI.
So they already incurred the massive cost of building these facilities and securing the power.
Which is the hardest part. Now they can leverage those existing assets, repurpose that compute power for AI applications, which carry potentially much higher, more stable margins than just mining a volatile commodity.
Okay, so they're shifting from a commodity business to more of a tech infrastructure service provider. That makes them a proxy for the AI build-out itself.
Precisely. And the market loves it. It separates these strategically minded players like Cipher from the miners who are just exposed to coin prices. Investors are saying, okay, we're willing to give you a higher tech-like valuation multiple because you have this valuable infrastructure.
And we're seeing confirmation of that AI theme elsewhere this morning too, right? Like with NVIDIA.
Absolutely. Look at the anchor stock, NVIDIA itself, NVDA. It's up over 2% pre-market on really heavy volume, over 180 million shares already. When you see that kind of sustained buying interest in the leader, it confirms that the core belief in the AI narrative is still incredibly strong at the individual stock level. That creates a bullish backdrop for these thematic proxies like CIFR. And of course, all of this just ramps up the importance of tonight's earnings.
From AMD and Supermicro, it all connects. Okay, let's pivot from those pre-market movers to the scheduled event risk. The earnings calendar is packed. Before we get to the really big ones tonight, what should we be watching for this morning? Any key reports coming out before the market close?
Yeah, the morning session has a mix. We've got Big Pharma reporting Pfizer, ticker PFE, and Amgen, AMGN.
Pharma always interesting. What's the focus there? Beyond the usual revenue and pipeline updates.
Well, right now they're reporting against a backdrop of pretty significant regulatory risk. All the political pressure about lowering drug prices, managing healthcare costs.
So the focus shifts more to how they're managing those pressures, their cost controls, their guidance.
Exactly. Investors will be looking closely at their R&D pipelines, sure, hoping for the next blockbuster. But maybe more importantly, they'll want to hear concrete plans for cost mitigation. How are they going to protect margins if pricing comes under pressure? Interestingly, Pfizer, PFE, was barely moving pre-market, just slightly positive. It suggests these reports are maybe more about sector health than triggers for broad market volatility today.
Okay, pharma watching costs. What else this morning? Uber, right. UBER, that's a big one for the gig economy.
Huge barometer for the gig economy and consumer spending, yes. For Uber, the deep dive is all about the quality of their earnings. Forget the adjusted numbers for a second. Investors want to see a clear path to sustained profitability based on GAAP, generally accepted accounting principles.
Real net income, not just adjusted figures.
Exactly. Can they make money under the strict accounting rules? We'll also be watching their take rate, how much they keep from each ride or delivery. Is that growing? And of course, any comments on driver supply, driver costs, and the regulatory hurdles they always face in different parts of the world. That remains a constant risk factor.
All right, now for the main event, really. The reports after the market closes today, the AMC reports. You said earlier these are critical. Like, define the week critical for the NASDAQ.
Absolutely. These have the highest potential to really move the market this week. Tonight's results, particularly from the semiconductor space, will set the tone for the entire tech sector, all the related stocks, the ETFs, everything.
And the single most important report, the one everyone's watching, is Advanced Micro Devices, AMD. Why does AMD carry so much weight tonight?
Because the market is desperately looking for proof, for tangible evidence, that there's a real viable competitor to NVIDIA in the AI chip space. NVIDIA has had this near monopoly on the high-end accelerators.
So AMD needs to show they can actually take meaningful share.
Yes, expectations are sky high, especially for their newest AI chip offerings. The market needs to see more than just promises. They want confirmation of actual deal flow. Remember that Oracle partnership they announced?
Yeah.
Are partnerships like that translating into big orders, significant revenue? And crucially, what's the forward guidance for 2026 look like? This tells us if that massive wave of AI spending is broadening beyond just NVIDIA or if it's still highly concentrated.
Okay, so the risk here is massive. If AMD's guidance is weak or if those deals aren't materializing fast enough, what happens?
It could be ugly. A weak report from AMD would instantly reignite fears that NVIDIA's dominance is just too strong, that maybe the AI spending isn't as broad as hoped. That would put immediate, heavy pressure back on the whole NASDAQ complex, validating that cautious selling we saw in the M&Q futures this morning.
But AMD isn't reporting in a vacuum tonight. We also get Supermicrocomputer, SMCI. You called this the supply chain litmus test. Why is SMCI just as important, maybe even more so, for understanding the physical reality?
SMCI provides that crucial ground truth. While AMD tells us about the demand for the chips, the brains, if you will, SMCI tells us about the actual deployment. They build the integrated AI servers, the racks, the cooling systems, the physical body.
Ah, the physical build-out.
Exactly. Their results give us real visibility into whether companies are actually installing this stuff or there are bottlenecks in the supply chain. Are companies hesitant to spend the capital right now? SMCI's results, especially their backlog and margins, tell that story.
So the brain and body analogy you mentioned helps frame this. We need both reports together.
We absolutely do. Think about the scenarios.
Yeah.
Scenario 1, the bull case. Both AMD and SMCI are strong. AMD shows massive chip demand, great guidance. SMCI confirms the servers are flying off the shelves, backlog is strong. That's the dream scenario for AI bulls. The narrative is real, the spending is happening now. Market likely rips higher.
Okay, scenario 2.
Scenario 2, the bottleneck.
Right.
AMD is strong, the demand is there, but SMCI is weak. Maybe their margins are squeezed, maybe deployment is slower than expected. This suggests a bottleneck. The desire is there, but the physical build-out is hitting snags. That would probably cap the rally.
Makes sense. Scenario 3.
Scenario 3, the contradiction. AMD is weak, but SMCI is strong. This seems less likely right now, but it would mean SMCI is building servers perhaps for other chip makers or for general computing, while AMD is losing the AI race. Bad for AMD, but maybe okay for the broader infrastructure theme.
And the worst case.
Scenario 4, the bear case. Both AMD and SMCI disappoint. Weak guidance from both. That signals either AI hardware demand is cooling faster than expected, or maybe broader corporate capital spending is just getting slashed. That would hit the NASDAQ hard and confirm the morning's de-risking was spot on.
So the key takeaway is you really have to look at SMCI's numbers, their margins, their backlog, before drawing conclusions about the whole chip sector, even after you see AMD's results.
100%. You need both pieces of the puzzle. Oh, and we also get Rivian Automotive, RIVN, tonight.
Right, the EV startup. Less of a tech anchor, but still important.
Still important, yeah. It gives us a read on the health of these capital-intensive EV companies. The focus there will be on their production ramp-up, are they hitting targets? And, critically, their cash burn rate. Especially now, with the EV market getting more competitive and maybe normalizing a bit. Rivian's ability to manage costs and margins, it'll be judged by that same efficiency is king standard we saw with MD.
Okay, let's shift gears now from individual company risk to the big picture systemic risk. We need to walk through the macroeconomic calendar because this is what really moves the broad market and shapes what the Federal Reserve might do next.
Absolutely. And this week is seriously front-loaded with data that hits right at the heart of the Fed's concerns. The risk really ramps up as the week progresses. Hashtag 4.1, today's core indicators, November 4.
So starting with today, Tuesday, November 4th, first up, 8:30 a.m. Eastern, we get international trade data. The expectation is for a deficit around $60.4 billion. Why does the trade balance matter right now?
Well, the trade balance feeds directly into how economists calculate GDP. specifically the net exports part. So if the deficit comes in narrower than expected, maybe because exports were stronger or imports weaker, that's generally seen as a positive sign for Q4 GDP growth, kind of bullish for domestic strength.
Okay, so a medium impact number, but the really big one today comes later, right?
Yes. The main event for macro today is at 10:00 a.m. Eastern. That's the JOLTS job openings report. Our sources are flagging this as the likely trigger for the highest intraday volatility today.
JOLTS job openings and labor turnover survey. Why is this specific report so critical for the market and the Fed right now?
Because JOLTS is seen as the best real-time gauge of labor market demand, or tightness. Think of it as measuring how many help-wanted signs are out there relative to the number of available workers.
So it's about the supply-demand balance for labor.
Exactly. If the number of job openings is really high, it means employers are competing fiercely for workers, which tends to push wages up. And that wage pressure is exactly the kind of inflation the Fed is trying desperately to cool down. The last reading was around 7.227 million openings.
Okay, so what numbers should we be watching for? What kind of reading would signal trouble, meaning persistent inflation risk and a more aggressive Fed?
If we see an unexpected jump in job openings, say significantly above that 7.2, 7.3 million range, that would be bad news for markets. It suggests the labor market is still too tight, wage pressures will continue, and the Fed might have to keep rates higher for even longer or even hike again.
And conversely, a drop.
If the number comes in well below, say, 7.1 million, that could signal the labor market is finally cooling off significantly. That might ease pressure on the Fed, potentially leading to a more risk-on reaction in the market. Because JOLTS really gets at that core supply-demand imbalance, it's seen as a key leading indicator ahead of the actual employment numbers later in the week. Oh, and we also get factory orders at the same time, 10:00 a.m. So a snapshot of both labor demand and manufacturing activity hitting at once.
Busy 10 a.m. then. Hashtag tag 4.2, escalating midweek and end-of-week volatility.
And looking beyond today, the risk just keeps building through the week. The market's likely going to trade pretty cautiously until we get the full picture on employment.
So what's on deck for Wednesday, November 5th? What should listeners be watching for?
Wednesday is another potential minefield. We kick off with the ADP employment report at 8:15 a.m. Eastern. That's the private payroll processor's estimate, often seen as a preview, maybe an imperfect one, but still a preview, of the official government jobs report.
Okay, ADP first thing, then later.
Then at 10:01 for round Eastern Wednesday, we get the ISM Services Index. This one is hugely important. Services inflation is what the Fed is really worried about now. The ISM report measures business activity, new orders, employment, and crucially, prices paid within that massive services sector of the economy.
So if that prices paid number comes in hot,
It's a big red flag. It confirms inflation is sticky, it's embedded in the core of the economy, not just in goods anymore. That would likely trigger more defensive trading. Both ADP and ISM services are definitely high-impact events for Wednesday.
and then the grand finale, the biggest volatility event of the week, lands on Friday, November 7th.
That's right. The official employment situation report at 8:30 a.m. Eastern Friday. This is the most significant piece of monthly economic data, period. It's guaranteed to cause the week's biggest swings because it directly feeds into the market's pricing of Fed rate hike probabilities.
Non-farm payrolls is the headline everyone watches, but other parts matter too.
Absolutely. The market digs deep into this report. Average hourly earnings are critical. That's the direct measure of wage inflation, the unemployment rate, labor force participation. It all gets scrutinized.
Now, we flagged a potential wrinkle here. There was some talk about government shutdown risks potentially delaying this report. Is that still a factor?
It's a critical contingency to keep in mind. While things seem okay for now, the potential for a delay due to unresolved government funding issues always lingers. If, for some reason, Friday's official jobs report were to be delayed.
Then today's JOLTS and Wednesday's ATPism suddenly become even more important.
Massively more important. They would become the market's primary reads on the labor market until the official data could be released. It means that scenario planning, and maybe even hedging, around today's JOLTS release takes on extra significance, just in case it ends up being the main labor data point we get for a while.
Okay, so we've laid out these two powerful, almost opposing forces. On one hand, you've got this broad index caution, this nervousness driven by the heavy macro calendar, especially the labor data. On the other hand, you have these pockets of real conviction, specific stocks rocketing higher based on efficiency or clear thematic wins. How do you navigate that? What's the strategic takeaway for listeners right now?
The synthesis is pretty clear, I think. This kind of segmented market screams for active management. You need to be selective.
Passive index investing is risky this week.
It feels very risky right now, yeah. If you just buy the index, you're completely exposed to those systemic macro shocks. A hot JOLTS report, a hawkish signal from the ISM, a surprise in the jobs numbers Friday. Those things can pull the whole market down, regardless of how well individual companies within the index are actually doing.
But the opportunity is in finding those specific stories, the MDs and CIFRs.
Exactly. Those targeted positions, the ones backed by confirmed fundamentals like MD's efficiency or CFR's validated pivot, they offer that potential for real outperformance, for alpha. Active management lets you try and capture those specific gains while also managing or hedging against the broader macro storm.
And the timing of events this week really forces your hand tactically, doesn't it?
It really does. You've got JOLTS hitting mid-morning today, then the massive AMDS MCI earnings after the bell tonight. It's a tight cluster of potentially huge market-moving events. This demands a very tactical, probably shorter-term approach. Trying to predict the market's overall direction for the next week is tough given the Fed uncertainty. So the smarter play might be to focus on capturing volatility during the trading sessions while trying to minimize your exposure to overnight gaps caused by macro surprises. Hashtag tag tag 5.2 recommended adjustments and hedging strategies.
Okay, let's get really practical then. Based on everything we've discussed, what are the specific sector weighting adjustments someone might consider this week? Where should you maybe lean in and where should you pull back?
All right, for tactical overweight positions, I look at selectively increasing exposure to that digital infrastructure AI proxy theme. CIFR's move validates it, and there's huge anticipation around AMD and SMCI tonight. Capital is clearly flowing there.
Okay, overweight AI infrastructure plays. What else?
And secondly, healthcare services companies that are demonstrating that kind of operational efficiency we saw with MD. Look for margin expansion, disciplined cost control. The market is clearly rewarding that quality factor right now.
So overweight AI proxies and proven efficiency plays. Where should we be cautious maintaining neutral or underweight positions?
Definitely maintain caution, maybe neutral to underweight on broad technology indices, things like the QQQ, until we get clarity from AMD and SMCI tonight. If that AI story hits a bump, the whole sector could easily sell off.
Makes sense. Any other areas to underweight?
Yeah, I'd also be cautious on highly cyclical sectors and anything really sensitive to interest rates. Think housing, maybe some consumer discretionary names. That sequential labor data risk throughout the week, JOLTS today, ADPASM Wednesday, jobs Friday, any upside surprise there could reignite hawkish Fed bets and hit those rate-sensitive sectors hard.
Okay, sector weights adjusted. Now, managing the event risk itself. Hedging. Let's talk specifics. First, how would you hedge against a bad surprise in the labor data, like today's JOLTS?
Right, the labor data hedge. This is crucial for protecting against an unexpectedly hot number from JOLTS, or maybe the ADPSM later. A straightforward way is using defined risk index options. Consider the micro-E-mini S&P 500 futures options, the MES options.
Okay, MES options. What specifically?
You could look at buying some short-dated, slightly out-of-the-money put options that expire this Friday, November 7th. That covers you through the entire week's employment data dump.
Buying puts below the current market price.
Exactly. Out of the money means the strike price is below where the market is currently trading. The premium should be relatively cheap. Think of it as buying affordable insurance against a sudden sharp market drop triggered by bad macro news. It's defined risk. The most you can lose is the premium you paid, and it helps dampen that systemic downside exposure.
Okay, that covers the macro risk. What about the specific earnings risk tonight, especially for AMD and SMCI, where the expected move, the implied volatility, is already sky high? Buying puts there must be expensive.
It is. Just buying straight puts on AMD or SMCI right before earnings is likely paying a huge premium for volatility that's already inflated. A more capital-efficient approach is often to use defined risk option spreads.
Spreads, okay. Like what?
You could consider something like a put-debit spread. You buy one put option, maybe slightly out of money, and simultaneously sell another put option further out of the money. Selling that further out put helps finance the cost of the put you bought.
So it lowers the cost of the hedge.
Significantly. Or you could look at something like an iron condor if you think the stock might stay within a certain range, but want protection against a huge move either way. The point is, using spreads allows you to define your maximum risk and reward, manage the high implied volatility, and still hedge against a really severe downside surprise in AMD or SMCI that could drag the whole tech sector down with it. It's about efficient risk management for these known high volatility events. Hashtag tag outro.
Wow, okay. That was incredibly detailed. A fantastic breakdown of this really conflicted market open. Let's quickly recap the three absolute must-know takeaways for everyone heading into the trading day first.
First, those NASDAQ futures. They're signaling very targeted, de-risking, specific caution aimed right at tech, clearly anticipating tonight's high-stakes earnings after the close. The market isn't necessarily panicked, but it's definitely braced for impact.
Got it. Second key takeaway.
Second, that Pediatrics Medical Group story, MD. It's crystal clear. Operational efficiency, margin expansion, real profitability. That's the new king. Forget growth at all costs. In this higher rate world, the market is paying up massively for demonstrated margin health.
Efficiency over sheer growth. And the third critical point for today.
Third, the macro risk is front and center today with jolts at 10 a.m. Eastern. That labor data point is the biggest systemic hurdle right now. It has the potential to completely reset interest rate expectations for the week and really influence whether the Fed feels forced to stay aggressive.
Okay, jolts at 10 a.m. is key. Before we wrap up, you usually leave us with a final thought, something to chew on.
Yeah, just a provocative question maybe building on that MD theme. Given how willing the market clearly is to pay this huge premium for real structural margin improvement, take that benchmark, that operational efficiency test, and apply it rigorously to every company you hold in your own portfolio.
Okay. Ask yourself.
Ask yourself, are these companies laser-focused on disciplined profitability, on generating reliable cash flow? Or are they still stuck in that old playbook, chasing top-line growth, no matter the cost, a strategy the market seems to be actively punishing right now? And maybe the follow-up question is, which sector, one that's traditionally been all about growth, like SaaS or maybe biotech, which one is next in line to get fundamentally re-rated based purely on hitting those efficiency metrics?
That is definitely the lens to be using all week long. Fantastic insights. We really hope this deep dive gives you the clarity and the tactical edge you need for a successful trading week. Thanks for tuning in.
My pleasure. Trade safe.
We'll talk to you next time on The Deep Dive.